It was December 1983. Delhi's Harpal Singh, an Indian Airlines employee, received the keys to the first Maruti 800 from the then Prime Minister Indira Gandhi. Now, almost 40 years since the first rollout, Maruti Suzuki India has reported a more than 40% increase in net profit in its latest quarterly results. While the 800 has been replaced by the likes of the Jimny and the Fronx, India's largest car maker continues to register its name in history, with its total revenues in FY23 crossing the 1 trillion rupee mark. The importance of this feat was noted by Maruti chairman R.C. Bhargava, who said that he couldn't readily think of many other Indian companies that had done the same. So, what's continuing to make Maruti tick after all these years? In the immediate term, it's relatively improved volumes and improved realization. On the back of this, Maruti Suzuki India reported a 42% year-on-year increase in net profit at 2,670 crore rupees in the fourth quarter of FY23. The recovery in car sales and the easing in supply chain disruptions helped. For the full year, the company's bottom line more than doubled to 8,211 crore rupees from a year earlier. Meanwhile, total income surged 33% to 1.19 trillion rupees in FY23. Let's drive through the details behind this result. The 21% year-on-year growth in the car maker's net sales contributed to the almost similar percentage jump in its revenue from operations in Q4 FY23. And the operating margin increased by 138 basis points year-on-year at almost 11%. The key favorable factors were improved capacity utilization on the back of higher volumes, improved realization from the market, favorable forex movement, and finally, some cost reduction efforts.
Quarter on quarter as well as year on year, their PAT to sales have expanded very handsomely. If you look at expansion in PAT to sales in percentage terms, the role of non-operating income seems to be not significant. If you look at year on year, it's actually the other operating income, non-operating income has actually gone down by 70 basis points, whereas the EBIT has gone up by 90 basis points. So therefore, clearly it is the operating performance which is scored.
The fact that the average selling price of its vehicles jumped 15% year-on-year in Q4 FY23 at almost 6 lakh rupees couldn't have hurt either. The car maker also appears to be catching on to the changing trends. Maruti chairman Bhargava recently said that his company did not anticipate growth in the small car segment going forward. But the slowdown was not giving him sleepless nights because the company was performing well. He said the market had shifted towards sports utility vehicles and the company would do likewise with its plans to launch multiple SUVs during the current financial year. Maruti has also been slow in the electric vehicle segment. Hyundai, Tata Motors and Mahindra have already launched EVs in India, while Maruti is yet to drive into that space. But the automaker has plans to introduce 6 different models of EVs by the end of 2030, which will largely be in the SUV category.
New models, and especially in the SUV space, the pricing actually affords for greater return on per vehicle in terms of profitability. So if those vehicles where there is a greater return or profitability, those numbers go up, in this case like the SUV segment, then the overall profitability of the company would rise.
Maruti has also announced plans to set up a new plant to expand its annual capacity by 1 million units, since its existing capacity of 1.3 million is fully utilized. Meanwhile, another plant in Haryana with a proposed capacity of 1 million units is already under construction. On a separate note, Maruti witnessed an almost 9% increase in exports in FY23, reaching almost 260,000 units. Bhargava was optimistic that exports could reach 750,000 units by 2030.
The strategy would be to actually increase the amount of vehicles that they produce and increase the range of vehicles and plug the gaps that they have so that they retain at least the current market share which they have, if not improve it. The bullishness comes from the strategy to maintain their market share and knowing that they have a good response to the different models. The Jimmy had a very good reception, if you look at it. And then also in markets that they are overseas, looking at consolidating that position by increasing volumes.
But there are challenges ahead too. Maruti's rivals have well-developed EV plans. Even as the compact SUV segment achieved record volumes of over 1 million units in FY23, Tata Motors secured the top position in the segment, with close to a third of the market share in that period. Meanwhile, Maruti's domestic market share in terms of volumes stood at 41% in FY23. And while Bhargava said that the target was 50%, it was difficult to predict when that would happen.
The supply side shortages would hopefully ease off, and that if they don't, would affect the capacity utilization, and therefore adding of capacity would therefore be challenged by such issues. Maintaining the domestic market share and their margin would therefore be a challenge which on the numbers front they'll have to face or rather tackle while expanding their capacity.
In the longer run, experts say that what makes Maruti tick is that it has a strong Indian content. And while it doesn't rely on Japanese inputs as much as it once did, it still benefits from the best of that country's work ethics, frugality, and cost consciousness.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.